Welcome to the Stage Analysis Members Weekend video. It's Sunday the 15th of May, and today we're going to go through some of the regular weekend content, where I start with the major US indexes, see what's been going on there as we had a rebound attempt on Thursday, Friday. Go through the sector breadth, industry groups, and the US Stocks Watchlist near the end of the video. So I wanted to start off today with the indexes as usual. So the S&P 500 particularly as a starting point. So Thursday we got down towards the 380 ATR level and rebounded strongly through onto Friday with a lot of oversold groups getting some short covering type action. Software, semiconductors, renewable energy groups, a lot of beaten down areas in the market saw some strong moves in individual names with 20 to 30% pops in quite a lot of stocks. So some big price action moves, but the vast majority of them remain in deep stage 4 declines. So not necessarily anywhere near to stage analysis or Wyckoff method entry points as such yet. However, they could well be moving into areas where we've got potential for short-term trading action. So we moved up in the S&P 500. It closed back above the 280 ATR level, but still in stage 4 on the weekly time frame. This is a daily chart. You can see the percentage of stocks above the 20-day moving average shifted up to 23% with a move up from the deeper part of the lower zone. So it was well below 10% earlier in the week. So extremely oversold in the short term. If we look at the intraday charts, this is a 2-hour time frame. So you can see we've been in an intraday stage 4 decline since early April. We broke down stage 4 there on the 6th of April on the intraday chart. So one way you can use stage analysis is with a multi-time frame approach. So we have our weekly chart where we've got, so you can see the stage 4 decline on the weekly chart over the last 3 weeks. You've also got you can use stage analysis on the daily and intraday time frames, but less so on the daily time frames. It's not so good on stocks. So I tend to focus on the intraday chart using a 2-hour time frame with stocks, or a 1-hour time frame using the same settings as a weekly chart and then a weekly chart. So you determine the major weekly stage, and then you can drop down to the lower time frame, such as a 2-hour or 1-hour chart, to get an intraday stage analysis as well, which then can help you refine your entry points. For example, a pullback in a weekly stage 2 advance. So say up here in the S&P 500, this kind of pullback in here towards the 10-week moving average on an intraday time frame. We go back you would potentially be on a stage 4 decline on an intraday chart. So, and then you would start to form a stage 1 base and then start to move back out into stage 2 again. So once you get the stage 2 breakout on the intraday time frame, if we then go back to your weekly chart, you would then be coming back. It would potentially only be in an area such as this. So you might not even have you'll still be well underneath, making new highs. You'll be making an intraday breakout within a weekly base structure. So it can give you much earlier entry points in that regard. So coming back to the intraday chart of the S&P 500, I'm using the spider here, the SPY chart. So did initially have what looked like a selling climax back at the start of May. We had some strong volume down before reversing. It was the biggest reversal it had up into the prior resistance from the prior 2 peaks here within this stage 4 decline. So it was initially marked as a selling climax and automatic rally. So attempting to make the starting points of a base structure. So those that know the Wyckoff method, in a decline, when we get down to a low, we have a selling climax, and then we have a change of behavior up into a selling climax into an automatic rally, and then a secondary test, and then potentially move off, and then start to make a base structure and start to form a base structure before moving on up and out. So that's a typical kind of accumulation structure that we look for in the method. So this is a stage 1 base, then moving out into stage 2. So with that, the first part of that structure is a selling climax and an automatic rally, and then a potential secondary test. So in this area here, this was your secondary test area, but that test failed and it broke down, so it made a stage 4 continuation, and hence it's not a selling climax and an automatic rally. It's then potentially relabeled as just preliminary support, as this is just an initial attempt to stop within the stage 4 downtrend. And you might get multiple attempts like this within a downtrend. You can have multiple moves where ABC 1 2 3 4 5 type moves, Elliott wave. You can have attempts to base that then stop, fail, continue until you finally get that move that is that change of behavior, and then you start to make a base structure and start to form a broader base structure and a lateralization process and go sideways into stage 1. So at the moment we're not quite there yet. This next move that we've had with the bounce on stopping on Thursday and then following through on Friday, we're still in the short-term downtrend here, so we remain in stage 4. We've not got to a stage 1 basing structure on the intraday yet. So once we start to form an intraday stage 1 base, for example, if this continues through, we make it up to prior support, and then we start to come back in and start to make a broader base structure within here, then we'd potentially be starting a new stage 1 base structure, and we'd be looking for a move back out into stage 2, maybe further along the line, back up in this kind of area here. So potentially looking for that kind of thing to occur on the chart, but you don't always get that on the index charts. It's much more common on individual stock charts. With the indexes, you don't often make it all the way through to the latter stages of a base. You tend to break out earlier. So I tend to find that the index breakouts happen in the latter part of phase B sometimes. So just be keeping an eye out for that. So going to the weekly chart, the S&P 500. This week we had a demand tail, and we saw this across the board in terms of all of the major indexes. So a push towards new lows that was rejected later in the week. We stopped on Thursday and moved up strongly on Friday. Didn't close at any new highs, so not quite a spring attempt yet. Supply is still in control, but we had 6 weeks down now, and then it's attempting to make a reversal. So we'll be looking for a move back through last week's high, potentially for a short-term reversal on this, back up towards the bottom of the stage 3 range. But we remain in stage 4 on the S&P 500 here. It says copper here, but it's the S&P 500. And then NYSC, also similar behavior, demand tail on the bottom of that. You can see supply still in control, with it closing still lower on the week by almost 2%. Same with the Nasdaq. I've added the Fibonacci levels on the Nasdaq, not exactly precise, but it roughly moved down towards its 50% level this week, and again attempting to make a reversal move, a little bit stronger close compared to the S&P 500 there in terms of the wick on that candle. NDX, similar sort of thing, again smaller body on the candle there, another demand tail dipping down, prior support resistance kind of areas here, so we dipped down. So potential little undercut type move on the NDX into prior support level here. Haven't quite got through all of it yet, so looking for a reversal move. But as we know, we've got a lot of overhead supply in order to work through in all of these indexes. Again, similar on in that the Dow Jones here, demand tail on that, but still closed down on the week, down 2.14%. Small caps, same. Russell 2000, same type of action, again down on the week, 2.47%, still in stage 4, broke down into stage 4 all the way back in early January there. So it's been much deeper stage 4 decline than we're seeing in the larger cap indexes. And then the what's this one? The Amex, which has been our strongest stage 2 of late, has started to come off in the last few months now, starting to form a base structure. Again, rejected at the lows this week. It attempted to undercut, came down towards its 30-week moving average and closed around the middle of the body of the bar, but didn't get back above its 10-week moving average there, which is the equivalent to the 50-day moving average. So we'll be looking to see how that continues consolidating. Right, if we move on to the Nasdaq Composite here, you can see this is a daily chart, so we can see this in a little bit more detail. So Thursday stopping action up on strong relative volume there, and then Friday with the follow through, only broke 1 day's candles, so hasn't made any great strides yet, and it's still got a long way to go back up to that 200-day moving average. We're still 22% below the 200-day moving average. So even if we do have a big move, we've got a lot of overhead supply to deal with. So I wouldn't be expecting new highs anytime soon without a lot of grind to go on. So we could be attempting to stop here, and we could be attempting to make the start of a new base structure. But as I said, lots of overhead supply, so it could quite easily, on any kind of rebound, start to turn back down again and start to form basing structure. Look at the Russell 2000, similar type of thing, also a long way below its 200-day moving average. You can see it's another 18-19% to the 200-day there. Still got 10% back to the 50-day, and even 4% back to the 21-day moving average there. So a long way to recovery in these stage 4 declines that we're in at the moment, but doesn't mean we can't. There's potential for some big moves as obviously there's a lot of oversold stocks in the market that have had some deep declines, especially the aggressive growth areas of the market that have been totally destroyed over the last year, since they started breaking down all the way back in February time 2021. So Russell 2000 growth, again, also showing some relative strength on Friday there, but it's one of the weaker areas of the market still, and a long way to go back up to that 200-day, almost 30% to get back to the 200-day moving average there. So again, there's a lot. If we make it all the way back up just to near-term resistance in here, short-term move in here even could top and turn and start to come back down again and start to form a new base structure. So we won't be getting carried away with anything as yet. QQJs, the Nasdaq second 100 stocks, same price action. Again, a long way from that 200-day moving average. We're 27% below it. So lots of potential for big moves. Obviously, individual stocks in these indexes could obviously have 1 or 2 times the size moves that you can get in the indexes. So there's a lot of potential for big short covering type moves, but it's not particularly an area that we focus on in the stage analysis method or the Wyckoff method, as the entry points in the stage analysis method happen once you start to move into early stage 2. So as you can see, we're in stage 4 at the moment. So we're still looking for continuation moves on the downside within the stage analysis method, and using the Wyckoff method, if you're looking for long entries, you tend to not start to get the early entry points start at phase C of a base structure. So with this potentially being an initial selling climax now, we're only just in first or second event of phase A. So there's a ways to go on that, and so it's still entries still favour the downside in terms of on any rebounds up into moving averages and or into support. So still be looking for short entries at the moment as the primary focus, but to see if any of the base structures can start to develop before starting to get more interested on the long side again. So IBD 50, this is a weekly chart. So we've round tripped the entire stage 2 advance in the CanSlim stocks. So this is the top 50 growth stocks each week published by IBD. So you can see it's had similar type of behavior to what we've seen in the likes of the ARK funds. So big stage 4 decline since November time, started to break down November, December, before the major breakdown into stage 4 in the January and 20 at the start of the year. So again, little demand tail forming on this. Big old move needed to get back just to the 30-week moving average. So we're 34% below the 30-week moving average. So we're a hell of a long way away from potentially moving back into even stage 1, let alone stage 2. So this would have to have a big recovery, and then you could potentially get a higher base. If you did have a V-shaped recovery like we saw 2020, it's unlikely. That was obviously the Fed getting involved and free money coming in terms of payments from the government, so lots and lots of money coming into the market. V-shaped rallies are rare, so we haven't had too many of those. It's the base structures tend to take a lot more grind. You have an initial move up and then some kind of sideways grind before then finally moving off towards the upside if it's an accumulation structure. So which we will see how we move. But the VIX came off a bit on Friday again, as expected with the moves in the market. You can see relative, this is the S&P 500 at the bottom here. So the move up in the index obviously correlated to what goes on in the VIX inversely. So we're still looking for a move below this 200-day moving average here. So until we get below there, it's still a very difficult environment on the long side and unfavorable. So still more of a short seller's market, even if we do get some strong bounces over the course of the next week. We're still not below that 200-day moving average. So not out of the woods yet by any means, with only one strong day after a lot of weekdays. Right, let's move on now into the next part of the video, which is the sector breadth. So this is something custom that I do for the members each. I generally do it every couple of weeks. It's something I've been doing for years now. I'm basically came up with it a long time ago. It was my way of doing the sector bell curve in a quick way, but just using it for the major sectors to get a view of what's going on in the market. So when it has a scale from 0 to 100%, same as the bullish percent index and the moving average breadth charts. And basically when you're below 40% level here, so when you're below this level in here, you're in stage 4. When you're in the 40 to 60% range here, you're in either stage 1 or stage 3. And when you're above in this upper zone, you tend to be in stage 2. So it's a rough way of doing the stages without even looking at a chart. You can just see from the data. So this is the percentage of stocks above their 150-day, which is the equivalent to the 30-week moving average. Potentially change it to the 30-week moving average now. I've worked out how to do that in stock charts more recently, so instead of the daily, but they're very similar, so it doesn't make an awful lot of difference. When we are in the lower zone like we are currently, so this has come off a lot in the last few weeks. So I quickly open one from a couple of weeks ago. So we go back here, scroll down. Get this away for you. So if we go back through, so this is this week's chart now. So you can see the move down. So this was 3 weeks ago. So 3 weeks ago, the average was at 40.53%, and it had dropped 4% on the week. And sort of we had a mix between stage 1, stage 3, and stage 4 stocks, mostly stage 4, with the NYSE and the Nasdaq both in the stage 4 zone, with only energy and utilities still in stage 2. You can see basic materials, real estate, consumer staples were still in either stage 1 or stage 3. So with this kind of market, more likely stage 3. So if we now go back to this week's, you can see the shift that we've had. So from this to this, you can see the drop down here. Basic materials has come off multiple there. If we go back there, it's dropped 3 places, down from 50% all the way down to 20%. Real estate, consumer staples here. Consumer staples is still in the same spot, but real estate has dropped all the way down into the 10 to 20% zone. So as you can see, most of them have come off. We've now got an overall average that's dropped down from 40% down to 28%. So 12% lower than we were 3 weeks ago, with only 2 groups still in the stage 1 to stage 3 range, and only energy still in the stage 2 range. Individual chart on the energy, we look at the individual sector chart of energy. I haven't posted it, but basically that has come off. We were above the 90% level about a month or so ago, so it has come off by more than 10%. And if you're using a point and figure chart, when you reverse from a column of X's to a column of O's, which it would have done with that kind of move, because you only need a 6% move to reverse. So the fact that it's gone from 90 to 80, it's had a 10% move. So it's reversed from a column of X's to a column of O's at the top of the range. It hasn't yet gone through the 70% level. So will get what we call a bull top status. So it's a negative status at the very top of the range. So it's not yet on bear alert. So if it goes through the 70% level, it would be on bear alert. But at the top of the range, if it reverses to a column of O's, it's then on bull top status. So that one has come off a bit. As you can see, the vast majority of groups are sitting in the lower zone now. So back in 2020, in March 2020, all the groups were in this bottom lower below the 30% level, and they stayed there for a good couple of weeks or so, and then we started to see groups moving out. Technology was one of the first movers. It started to thrust back up through the 30% level, up through the 30, 40%, 50% levels, and moved up quickly, as did, I think, discretionary and a few other areas. So where our true market leaders were during the 2020 rally, and groups like energy didn't move back out again until much later in the year. So energy stayed in the lower zone, as did communication services and a few others. I think energy didn't come back out above the 30% level until August time. So technology moved out in April, and energy didn't move out until August. So you can see that's one way you can use this in terms of you starting to. This is a contrarian indicator as such. So when we're at this point, we're in an extreme state of the market where all groups are shifted to one side of the market. And when you're in a strong bull market, so back in January, February time, 2021, all the groups were in the upper zone above the 70% level. There was literally everything was at the top of the chart. So when we get extremely extended to one end of the scale, then potentially we're going to get some counter trend type moves, and we could potentially reverse. Eventually we will reverse the move that we're in, the stage 4 that we're in, and start to move back into stage 1 and potentially move back out into stage 2 again. So we're looking for the groups that start to move out first again once we actually start to move back out of this lower zone. At the moment, the fact that there's still 3 groups hanging on out of the top of the range is a little bit vexing, as obviously they haven't. It's a divergent market in that regard. Obviously, energy has been strong since the start of the year, which I've obviously highlighted continuously through the watch list, as it's been the vast majority of the watch list stocks have been in energy and basic materials, etc., which, as we saw, just has started to drop off recently. And the industrials, they were areas of strength through January, sort of March time, and they've started to come off dramatically now, with basic materials and industrials now getting hammered, whereas energy is still the only area really hanging on. So you can see further down the post here that I posted, we've got only 1 sector in stage 2, 2 in the stage 1 or stage 3 zone, and 8 in the stage 4 zone. So we need to start to see that start to shift around again, and I'll do the sector bell curve again in the coming week with the individual groups, and go into a bit more detail and start to see if anything's starting to move up. As we did on Friday, we've got not just 2 changes. There was multiple changes in the narrow groups. So there's 200 IBD sectors. So in those, I'm not sure of the exact number, there was 20 or more that basically moved to what we call a bull alert status. So a bull alert status is when you move from a column of O's in the lower zone to a column of X's. So basically they reversed back up. They haven't all gone through the 30% level. The traditional meaning of it is them going through the 30% level, but they haven't actually made it up through there yet. So they're just, the majority of them were software, semiconductors, some medical groups, and a few others. Can't remember off the top of my head all of them, but it was mostly the software and semiconductor groups were a big part of it. So I highlighted that on the watch list post there. Go further down the post, you can see the individual percentages. So have a look at that yourself in your own time. We'll move on to the next now. So